Hi, my name's Andrew Grant, and I'm the Director of Manager Research and Investment Solutions here at Kayne Anderson Rudnick.
And I'm Thomas Pontius. I'm the Senior Financial Planner here at Kayne Anderson Rudnick, and today we're going to talk about wealth preservation strategies.
Since this month is Financial Literacy Month, we thought it'd be great to go over a few points and items that we had that come up with a lot of our client conversations. And Thomas, I think, you being the, head of financial planning here, maybe you could start talking to us a little bit about initial pieces that you run into when talking to clients about wealth preservation. Why does it matter?
Yeah, preservation is really kind of the next step after clients get out of their accumulation phase of assets. So they've worked their entire lives, they build up this base of assets, and really the next part of their life when they enter retirement or they start drawing off of those assets, preservation is incredibly important to make sure their assets last them over time. So making sure that the assets last, also providing them financial freedom, and making sure that you're not taking too much risk are really important pieces of preservation and why it's important.
And let's just go back to basics in 101. I think saving is typically the most important thing for people. When they think about wealth preservation, it's just starting to save from a very early age, understanding what your debt is, understanding what your expenses are, and really just being invested. And if somebody can just sort of hit on those 4 items alone, I think they're far ahead of the game, right? So, I don't know what else you're seeing from kind of, an investment decision when people come in and meet with us at first. What are some items that they seem to be missing, Maybe you could walk us through a couple of those pieces.
Yeah, I think from the preservation standpoint, when people say, hey, we're looking to retire now and we need this base of assets to last us for the rest of our lives, it's kind of a transition from, okay, we had income before, we were spending X amount of dollars, and now we really need to look into, for the first time in our lives, instead of saving, instead of putting assets into the account to grow for us, we're now taking the assets out of the account to help pay for our living expenses and whatever it might be. So now our risk profile changes a little bit. Instead of our portfolio assets growing for us and we're not drawing off of them, in that scenario, when we have income, we can take more risk on the investment portfolio. But now we need to understand what our draw is off the portfolio and how that relates to the risk that we're taking on it. If we're taking too much risk and in a down market our portfolio assets drop and we're still taking that distribution off the account, that could be problematic because we could really dip too deep into the portfolio assets where we're not able to recover on the upside. So one of the biggest risks is obviously the investment risk with that. We have to be conscious of taxes. We have to be conscious of the timing of withdrawals and really thinking strategically and on a longer term plan about how this base of assets is going to support us.
Right, and you help model that out for
Exactly.
people, right, over long periods of time.
Exactly.
Right? Yeah, and so much of that, when you start thinking about the investment side of it and why, when it comes to investing, diversification matters, right? We definitely have periods of exceptionalism in the US or Europe, depending on what's going on in the environment. But people need to be diversified so that they can have those long-term plans in place, right? You run those simulations all the time. And again, by having a properly diversified portfolio of equities, fixed income, and today, alternatives have become a big discussion, right? There are ways to help improve your alpha, generate alpha, and that can be in the form of multiple alternatives. We can help people with lowering volatility. We can help people improve their income, and we can just help diversify them away from what's going on in the publicly traded equity markets and fixed income. And like you brought up earlier, taxes are always a big issue, and what we want to do is find the types of vehicles that can help them with that. On your end, when it comes to financial planning, what is it that you're seeing from a tax standpoint?
Yeah, I think there's a lot of different ways to be tax efficient. You hit on some of the ways from the investment side. If you're investing in something that's kicking off ordinary income in an IRA, that's going to be more tax efficient than that type of investment being placed in a brokerage account. But there's also strategically, when you're taking draws off portfolios, where should you be taking those draws from? When are you taking Social Security? Those types of questions are why a plan really matters. And if you are tax inefficient over the long run, that's just going to also deteriorate the base of assets that you have. You don't want to be overpaying taxes if you don't need to. And if you haven't thoughtfully crafted a divestment strategy from your assets to support your living, then you could be overpaying in taxes. And that's why a lot of the tax planning that we do attempts to be very proactive. We want to see what someone's tax scenario is. We want to look at the most recently filed tax return, and we want to strategize around that to say, okay, you have XYZ in this type of income. This is going to be the best place for you to draw off of, or these types of investments are going to be better placed in these IRAs or brokerage accounts and things like that. So the tax risk overall is massive, and there's so many different types of taxes. There's income taxes, there's estate taxes, there's net investment income taxes. All of those taxes we want to be conscious of and strategizing around ways to help mitigate or lessen that burden and not overpay taxes if we don't need to.
Yeah, and from my side of it, right, the investment side and the vehicle structure, we try to have vehicles that are as tax efficient as possible, right? We're seeing a large influx of funds flow into ETFs because they're more tax efficient. We pay attention to what capital gains are in mutual funds still. Some of them might still make the most sense to have, but we do look at tax efficiency. Separately managed accounts, right? The ability to tax loss harvest, any of those individual positions in there are things that we pay attention to. And I think a lot of what people are hearing today is about direct indexing, where you are going to get an index-like return, but tax alpha, right? It's paying less in taxes because you took those tax loss harvests throughout the year to offset any gains that you might have had in your portfolio. So from a vehicle standpoint, I really think that it makes a lot of sense to think about the taxes behind it. It's become much more front and center these days with clients when they're thinking about how much more efficient can I get with my taxes.
Yeah, and I think it's really a core principle in wealth preservation is to reduce taxes as much as possible, and we really want to stay focused on that. I would say another perspective on wealth preservation and core strategies aligned with that is also estate planning and making sure that your estate documents are in order today. So ultimately the assets that you have are, one, protected in ways, and two, are also, after you pass, are distributed the way that you want to see them distributed. Having a revocable living trust is one of the best things a client can do. First of all, the assets titled in that trust can avoid probate. And second, you're able to stipulate how those assets are going to pass, not only to the surviving spouse, but also to your kids. And that's really important for a lot of people, especially depending on, life is uncertain. We don't know when that event is going to happen. And so making sure that those documents are in order and you've reviewed those documents on a 3-4 year basis to make sure that they stay up to date is somewhat of an insurance that those assets are going to pass the way that you want them to. And again, from a wealth preservation standpoint, they're not exposed to a distribution from an IRA that happens too quickly that forwards taxes. So there are things to be concerned about from an estate side, even though it may not necessarily be very quantitative, but it is very important to the overall wealth preservation strategy.
Yeah, I mean, going back to the investments, right, we need to think about solutions for people, right? If they're trying to defer taxes, if they're trying to find a way that will allow them for a step up in cost basis, right? So with real estate, we have 1031 exchanges. So again, it's solutions that we can do to help them not pay as much taxes now and think about the future and the heirs within their estates.
And I think it's important to have that conversation with the members of the family that you want to include to make sure that the right people are named in the documents. A lot of times we see trustees that no longer have relationships with the family because the documents are 20 years old and that person is no longer a part of their life. Beneficiaries that no longer should be beneficiaries of the estate. So again, reviewing those things, and those are the types of mistakes we see from the estate planning side. From the tax planning side, I think I talked about it a little bit earlier, is, where are you taking distributions from? Are you exposing yourself to more taxes? One circumstance that we saw recently was a client whose investment mix was generating so much in ordinary dividends and interest income, and that was putting him above the 37% tax bracket. And if he just reallocated the investments to be more focused on tax-exempt income and generating qualified dividends from the appropriate investments, he roughly could have saved, 10 to 15% on his tax bill every year. So those are the types of mistakes that we see that are easy to correct if the client has the right guidance, working with an advisor, and they understand what they're looking for.
Yeah, sometimes the easiest ones are the hardest ones sometimes for people to control, which I see so much on our side. I saw a statistic the other day that, and I'm going to talk a little bit about behavioral finance here, is this is one of the biggest issues that I see in terms of clients' returns, is making irrational decisions based on what's going on with the market. This study I saw the other day, a typical retail investor had half of the gains of the S&P 500 over the past 40 years because they were making poor timing decisions. So it's about long-term investing. It's about staying in your seat, staying invested, not having these worries about fear of missing out when a specific sector or an area of the market is really moving. So for me, it's back to the basics. It's save, it's behavioral finance 101, stay invested, let compounding do its trick for you, and keep putting money away in that 401k. So those would be my top choices for wealth preservation.
Well, Andrew, thanks for sitting down and talking about wealth preservation strategies today. I think there were a lot of really helpful insights that investors should be taking away from this and really be questioning as they think about their wealth preservation strategies.
Yeah, I thought we hit on a lot of great topics, and I think hopefully everybody got a lot out of this session. I know I did have a better understanding of financial planning and wealth preservation myself. Again, everyone, thank you for listening, and we hope you have a great day. Thank you.